I'm going to share with you guys these 7 elements to create a high probability ICT trading model. I think most of you guys watching this video right now are missing more than one of these, and I think it can be the missing piece in the technical sense. Let's dive straight into it. The first one is knowledge of market conditions and profiles. It's important to understand that there are 4 phases of price delivery. Price is in expansion, it's in retracement, reversal, or consolidation. So identifying the current market condition, whether it be in an expansion day, consolidation, whether it's going to reverse or retrace, is absolutely paramount. Where most traders fail is they fail to identify a market condition where their entry technique is highly probable. Now, some traders, they'll look for a reversal model, but the market will end up being in a market condition where it's just chopping sideways. So on the left, this is an example of an ICT classic buy day where price will open up. There's manipulation beneath the opening price, and then it's trending the rest of the time. Okay, on the right, this is a consolidation profile where it's just moving sideways. It's not really seeking any higher time frame target. A big misconception in the trading space is that there can be a model and then you could just enter that model anytime, right? There needs to be a specific market condition paired with your specific entry model. If you don't have that, you're going to end up looking for a reversal trade. Let's say you're looking for a 2022 model, and here everyone knows the 2022 model, right? Market structure shift, fair value gap. You could be looking to long somewhere in here where my mouse is because it created a market structure shift above this high, but then you end up getting caught in consolidation the rest of the day. So, and then the next time, you might just target a short-term high and it ends up trending the rest of the day. So a big question to ask yourself is, what is the market likely to do today? Is it likely to be an expansion the whole day? Is it likely to retrace? Is it likely to reverse? Or is it likely to consolidate? Once you have that, then you can move forward throughout the other elements of a trade setup. So the first thing you need to ask yourself, is this a high probability market condition for my trade model? Meaning, if I'm trading silver bullet, which is a return to a fair value gap, and then price is going to seek liquidity. If price is in a small range consolidation profile, I'm not going to be looking to take that silver bullet as it's not really delivering to a specific level of liquidity. So it's really, really important to identify a market condition that suits your trade model the best. So now let's dive into a price chart on the NASDAQ and how you can identify an expansion day versus a consolidation day. So it's important to understand where is price currently on the price chart. Now, if you look at these 3 relative equal lows, this is where my eye goes to, and it absolutely matters where price is on the current price chart. So you see these 3 relative equal lows in here. When I see this sharp move down, right, this is just manipulation to trigger these stop orders. So it's smart money targeting these lows for a specific reason to trigger sell stops. So smart money has a counterparty to their buy position that they're trying to scale into. So when price takes out these orders, I know that there's going to be a lot of sell orders hitting the marketplace, and smart money is going to be buying those up. So when it fails to displace beyond this low, and then it trades back into the range and it displaces back up, this is a signature that shows me that smart money has likely bought from the sell stops down here. And another reason that would make the case for that is that it left behind these relative equal highs above. Now you may be thinking, what does this have to do with the current market condition? But it absolutely does have significance, and it weighs into whether price is going to be in an expansion day or in a consolidation day. When price runs out this liquidity and fails to displace beyond it, and then we get a close over this down candle right here, that's a change in the state delivery. Okay, the algorithm is now shifting from a sell to a buy program. Okay, then it consolidates, and then it starts to expand back up. What's going to be the draw on liquidity now? It's going to want to reach for the buy stops resting above. Why would it do that? If smart money's long, they need someone to sell to at a higher price. So in this scenario, when they knock out all of this liquidity, smart money buys that up. They're scaling into their long position, and then once it starts this buy side of the curve, they're going to target buy stops to sell to at a higher price. Okay, Dan, what does that have anything to do with this? Well, once 8:30 hits, I know that price is likely to be in a continuation. It's likely to be in an expansion until it reaches the buy side liquidity resting above. Meaning, going into Thursday, let's say I'm viewing this pre 8:30 open, right? Let's say I'm viewing price in here. I know that today is likely to be a trending day because it has liquidity resting above that smart money is going to target since they bought the sell stops at a lower price. So we can utilize the price chart to identify if price is likely to reach for liquidity or not. Why is it likely to expand on this day? Because it knocked out a lot of liquidity, and now smart money is going to target the opposite side of the range because they're already long down here. They need someone to sell to at a higher price. You have this high and you have this high. So this is likely to be an expansion day to reach up into here. So that is one way you could identify a market condition where it's likely to be a continuation. It's likely to reach for liquidity. Now, what about a smaller range consolidation day? So we do have this right over here, where if we drop down into a 5-minute chart, right, how can we know that this is likely to just be such a weird day where it's just moving higher, retracing back in the range? You really get one nice low resistance liquidity run move to the upside, and then it just chops the rest of the day. So how can we identify this beforehand? That's extremely important to be able to do that. Well, it all starts off on a higher time frame to understand why price is consolidating here. Before we do dive into that though, I do have a private Discord, and I did alert to them beforehand. Before the day started, I anticipated a very choppy day today, and we'll be diving into the reasoning behind that. But I do have a Discord where I do share my higher time frame analysis and day trade setups on the NASDAQ, S&P 500, and occasionally the Dow Jones. I also do have a few courses in here and a library of over 50 videos explaining ICT concepts. If that's something you guys are interested in, there is a 3-day free trial link that you can find down below. So now back to this price chart. I'm going to show you guys when you can anticipate a consolidation. Now, it's impossible to find a video where you can just find every single market condition and perfectly when it's going to work out. So really what I'm trying to inspire you guys to do is to find one market condition and find the market condition that suits the entry model that you're looking for. So that's extremely important for a high probability trade model. You could wait for a large pool of liquidity to get ran and then wait for price to displace back into the range. And if it's around 8:30, likely it's going to expand towards the opposing liquidity. So that's one market condition where the AM session or the whole day, depending on how far away the liquidity is, price can just be an expansion because it's reaching for liquidity. Now, in this example, price had a large range day on Thursday. Okay, it was above previous day high, and it was also at equilibrium. What does ICT teach? At equilibrium, consolidation can occur. Consolidation can occur after a large range day. Okay, and it's above previous day high, and the draw on liquidity has already been hit. We have multiple elements here that suggest that this is likely to just be in a choppy condition. And what do you know? Price just chops pretty much the whole day. Yeah, you do get one nice run for an hour, but then the rest of the day, I mean, this is not price action you want to trade right here. So I think a big thing that traders miss out on is they'll see this and they'll just view ICT from the pattern sense. Like, you might look at this right now and think, well, we have a market structure shift right here. I was buying this fair value gap end of the day, but it's on a day where it's likely to do nothing. Why? Because it's at equilibrium, it's after a large range day, and it's above previous day high. The draw on liquidity was already hit. Price isn't reaching for anything. So that's extremely important to understand. You're trying to frame a day like this, right, where it's clearly reaching for liquidity. Okay, at 8:30, what is price likely to do? It's likely to start expanding up higher because it already knocked out the liquidity. Okay, if you're trading a trending model, right, or if you're trading a reversal and you're trying to expect price to reach a higher time frame target on a day like this, when you identify the current market condition, it can save you from buying that fair value gap and just getting caught in chop. Now, if you guys want to learn more about ICT market profiles, I will drop 2 videos down below where ICT specifically talks about them, but there are still more elements that you need to understand. So let's get on to the next element, and that is time and price theory. Time is over price. So it's time then price. Price waits for time. It's not the other way around. Meaning price could be at a good area where it's where it could reverse at. But if time is not aligned, price will wait for time, and then it can expand. So a question to ask yourself, is it time for price to move? You could see in the top right here, ICT tweets, and he says the economic calendar is your first step. So we can use medium to high impact news events, right? This could be an element of time that you're looking for. You're waiting for these medium to high impact news events to hit the marketplace. Okay, you could also use things like 8:30, 9:30 open. These are times where we can expect volatility. There are injections of volatility into the market. So a lot of smart money reversals can occur around those times. And we're going to take a look at a price chart, and I'm going to kind of show you the validity of time over price. So I'm going to show you guys why time is more important than price. Now, if we take a look at these blue flags, these represent key times of the day. This represents 9:30, 9:30, this is 8:30, and this is 8:30. Now, why are these times? We're just going over 2 times in this video, but I just want to show you guys that price waits for time. So it's not the other way around. If we take a look at this example right over here, you'd see that this down close candle right here, this is a bullish order block. So you'll notice that we do have 3 consecutive down close candles in here. So this is the entire order block, but this last down close candle, this is the sweet spot of the order block. Why is time more important than price? We have a fair value gap right in here. This is your price levels. These are the levels that you're waiting for price to return to before going higher. Why? Because it's in an OTE, right? We have the order block, the fair value gap. If order flow is truly bullish, this is an area that price can respect and then set a new high. Now, over here, you can see that this is at 5:30 a.m. So it's at the correct price level. But what's the problem here? Time is not aligned. So if you see at 9:30, price manipulates down, takes out stops once again. It also takes out this previous low over here. And price is waiting for time, okay? Price is not just consolidating in here for no reason. It doesn't just magically reverse at 9:30. What it's doing is it's trapping in that liquidity that's brought into the marketplace at 9:30. Smart money's buying up those stops. They're triggering this short-term low. So in London, you get that fake bounce, sets a new low. This open, it opens up, manipulates down, smart money's buying down here, and then price expands away. So it's important to understand that yes, price can be at good price levels, but if time is not aligned, then price will not reverse yet. Here's another example up here, okay? You can see that price is around this previous high up in here. Price does not reverse out of this consolidation at a random time. It waits till 9:30, it triggers the stops resting above here, and then price can reverse the downside. So sure, it's in a area where we have this liquidity void. This is an area where price can reverse at. Okay, but what's the problem here? Time is not aligned once again. So on Wednesday, okay, at 9:30, it manipulates the stops. This is a Judas swing higher, and then price can reverse. It's at a good price level, but the time was not right until Wednesday at 9:30 a.m. Down here, price is in a consolidation. What allows price to leave this consolidation? It's time. Price is waiting for 8:30. That's the news embargo lifts. It's when medium or high impact news can start to hit the market. So you see price is in this time distortion right here as it's waiting for time to allow for expansion. So you could be buying at the right level, which is the inversion fair value gap in here. But since price is waiting for 8:30, right, the correct time to buy would be right before 8:30. Now you could buy at the bottom here, but you're just going to sit through time distortion until time allows for expansion. Another example over here, okay, price is at this order block, okay, price taps it, taps it, taps it, okay, it's around this general area. You also have this fair value gap, okay, price pulls down. It's waiting for 8:30 to manipulate these stop orders right here. Okay, once those stop orders are manipulated at a key time, which is 8:30, then price can reverse and create the SMR and then head for the upper part of the range. So time is absolutely more important than price. If anyone says otherwise, they're uninformed, unfortunately. So now let's dive into narrative, which is the why. This is one of the most important elements to a trade setup. If there's no narrative involved, you're a pattern trader, unfortunately, and you'll just be looking for certain signatures with no reason as to why price is moving up or down. So I'm going to show you guys an example of what narrative looks like. I just added the blue flag here again just to show you guys the time element here. You'd see that there is this big gap right in here. Price is at a good price level. What's the problem again? Why isn't price reversing? It's waiting for time. Simply, that is the answer. So at 9:30, price manipulates higher, it takes out the short-term high, then price can displace and see expansion back to the downside. So price is at a good level, it's waiting for time to be aligned. Now what's the why behind price action here? So it's in a premium, it's in that gap, price starts to expand to the downside, right? If I'm looking at this from just a pattern perspective, I could just wait for price to go beneath these lows and I could try and buy it right away. But price doesn't do that. What does it do? It just cuts straight through it. Why does price just cut straight through what looks to be liquidity? Well, the answer is more than just narrative, but part of the answer is narrative. So if we go out to a daily chart, okay, you could see that this is on the S&P 500. What did price do? It completely filled in this fair value gap. So ICT teaches that the market's seeking liquidity, or it's seeking imbalances. Within that logic, it's seeking to make inefficient price delivery efficient. So it's going to rebalance these large imbalances, which price does right here. It takes out the previous day high. But what is price in? It's in a higher time frame market maker sell model. So in short, it left behind these two relative equal lows. There's liquidity resting beneath there. There's liquidity resting beneath here. And there's all of these clustered lows close together. Okay, which means what? It means there's lots of orders resting below. The market is going to go to where the orders are. I cannot stress that enough. It is extremely important. Smart money, they're not using these random patterns just for pattern's sake. It's repricing to orders. So smart money has a counterparty to their transaction. So when we get this fake bounce here, it leaves these relative equal lows. Okay, why is price not bouncing after taking out this liquidity? Because simply price was just going higher to fill the imbalance. So when it reverses at a key time, what's it going to be doing? The higher time frame objective is lower. It's reaching for all of the orders on the left side because there's a lot of lows clustered close together. And when that's the case, there's a lot of liquidity resting beneath there. So that's where the algorithm is going to start to reprice to. So once it reverses, it takes the stops, it rebalances the imbalance by hitting the top end of it and displacing down. It's going to expand beyond these lows for the purpose of targeting bigger liquidity resting below. So the narrative is smart money got short, and they're going to be targeting where all of the orders are resting. So yeah, sure, there's orders resting beneath each of these lows, but where's the majority liquidity? It's based on the higher time frame. So it's going to reprice down to these lows, double bottom traders, right? People thinking that price has shifted just based off of market structure, right? A lot of stop orders are resting beneath here. So the narrative is smart money got short, and it's repricing for higher time frame liquidity. So just because I see a few lows in here doesn't mean price should turtle soup it. There needs to be a higher time frame narrative, number one. Where's price seeking liquidity on a higher time frame basis? And then we could scale down to the lower time frame, and lower time frames are just simply subordinate to those higher time frames. So that's the logic behind this. Smart money got short after it reached a deep premium. It took out stops, right? It reversed at a key time, and this sharp displacement away after that 9:30 Judas swing, it's simply just going to reach for liquidity. Now the next element is market structure. Price does not move up in a straight line. As I showed you guys before, there are 4 phases of price delivery. Price can be in a reversal, which we see up here in the top left. Okay, price could be in a retracement back to the upside. It could be an expansion, and it could also be in consolidation. So I think a lot of new traders, especially, they'll see these expansion moves and they're not thinking through the perspective that market structure is not just going to go up in a straight line. You can anticipate at specific areas, you can anticipate retracements, right? Consolidations, things like that. So it's important to have a overall understanding of what the market does through market structure. So another thing that's important to understand is that you get these large expansions, yes, but the new traders, they're not thinking about price delivery. They're just thinking, okay, price expanded off of this low. It's drawing towards a higher time frame level, right? And they end up buying up here. And then price retraces, it hits their stop, and then it expands higher. So it's important to realize price moves from expansion, then it can move into a retracement or a consolidation, followed by another expansion. Okay, so you get these large moves, but then they're followed by those retracements and consolidations. Even if price is going to reach up to here, every high probability strategy needs an overall understanding of market structure. It's not just going to go straight line up to that level. Okay, it can move in something like this where we get an expansion, retracement, or consolidation, and then a continuation of that expansion towards a key level. So far we have market condition, time and price theory, narrative, market structure, and we're going to move on to the next one now. So now we're going to dive into the fifth element, which is real order flow. So bearish institutional order flow, when the price chart's bearish, price retraces up into old up close candles and then expands away from them. This is what real bearish institutional order flow looks like in this picture. You can see price retraces up here, taps into this up close candle, expands away. Okay, we don't get a retracement into there on this one, kind of consolidates this up close candle or returns into this up close candle. And you can see that price is just referring to these old up close candles. This is real bearish institutional order flow as price is reaching for a higher time frame key level below. On the right, we have bullish institutional order flow. If price is reaching for a key level up here, you're anticipating for order flow to be bullish, meaning we're anticipating for price to return to down close candles when institutional order flow is bullish, meaning when it's targeting a key level up here, right, we're not going to get trapped into buying right here because we understand that price moves from expansion and then it can go into a retracement or consolidation, right? It's not just going to keep on going up in a straight line. So we can anticipate these retracements into these key levels, which is higher time frame order blocks. So this down close candle price refers to, expands away. Price returns back to these two down close candles, and then it expands away. And even in the top right up here, you can see that price expands away, refers back to these two down close candles, and then expands away again. So understanding that in real order flow, when it's bearish, price refers to up close candles as real resistance and expands away from them. In bullish order flow, price returns into down close candles, refers to them as real support, and then expands away from them. So what you may be starting to understand or already have the overall understanding of is that it's extremely important to understand what the market does. So though your entry criteria may not be based off of bullish order flow or that understanding of market structure, knowing what the market does is extremely important, because if you know what it does, then you can use that logic and learn how to enter it. Okay. The next thing, the sixth element, is sound money management. So you need to have a risk plan. How much are you willing to risk each trade? The dollar amount or percent amount, it should be written out. How many trades per day / session can you take? How many losses per day before you stop for the day? How many losses per week before you stop for the week? How many losses in a row before you reduce the dollar amount of risk or the percent amount of risk? And how long do you stay in a lower risk before returning to normal risk? So you need to have all of these written out, and it can't be left up for interpretation in the moment, or else you're just going to end up risking too much or being in a higher amount of risk when you're already in a negative state of mind. That's extremely important. So I encourage you guys to screenshot this, put it in your notes, and then answer each of these. I do think that it will be extremely beneficial. Every trader needs sound money management and a risk plan. And the last, which is the seventh element, is excellent entry and exit criteria. It needs to be a rule-based system. When you leave your entry and exit criteria up for interpretation, yes, you can anticipate the market condition. You can identify key time and price levels. But when it comes to entering, when price starts to expand away, you'll end up chasing it. Or when price starts dropping fast, you'll end up chasing it. So the entry technique, it needs to be absolutely mechanical. So it 100% needs to be written out before the fact, and if price does not do exactly what your entry technique says it needs to do, you're not allowed to enter the trade. Same with exits. So having this, it removes the necessity to make a decision on the spot, because when you have to do that and you're in a trade and price is really ripping without you and it's in a low resistance liquidity run, it's super easy to become impulsive in the moment and trade everything outside of your model. So that's going to be it for this video. For a recap, what we talked about for a high probability ICT trading model, you need to understand the current market condition. Time and price need to be aligned. Okay, there needs to be a narrative. Why is price going to do what it's going to do? You need to have an overall understanding of market structure, okay, and real institutional order flow, right? There needs to be a risk plan involved, and also excellent entry and exit criteria. I think if you have all of these lined up, the last missing piece is just yourself. So that's going to be it for this video. I give credit to ICT. I learned this information from the Inner Circle Trader. You could find him on Twitter and YouTube. And I will see you guys in the next video.